Hello and welcome back to the Wall Street Petting Zoo. I'm Christopher C. Smith, and Robert can't be with us this week because we just couldn't find a time when our schedules overlapped. So I'll be doing this one solo, and then we'll be back next week with a full episode with both me and Robert. Monday and Tuesday this week, the market posted some modest gains despite continued fears of conflict in Iran. Oil and gold in particular rose Monday as investors hedged against the possibility of an escalation of the conflict, and tech stocks like Google and Netflix posted particularly strong gains after some analyst upgrades of those two stocks, whereas bank stocks like Bank of America and JP Morgan suffered from analyst downgrades on those stocks. After market Tuesday, stocks tanked and gold and oil prices soared on reports that Iran had fired missiles at U.S. forces in Iraq. However, by the next morning, it was pretty clear that the missiles had caused no casualties and that neither the U.S. nor Iran intended to escalate the conflict further. Stocks surged higher and oil and gold prices tanked on Wednesday morning as a result of that. Oil prices were further depressed Wednesday morning by a bearish inventory report from the Energy Information Administration on Wednesday morning, showing that oil inventories have increased, which suggests that oil demand has weakened somewhat. One market segment that benefited from falling oil prices was airline stocks, with the JETS ETF moving higher the rest of the week. One more news item that I think investors missed on Wednesday was the November Consumer Credit Report, which showed a fairly large slowdown in the increase of consumer credit. Consumer finance stocks moved slightly higher on Wednesday, whereas I think they should have moved lower on this news, and in fact, they did move lower later in the week. After market Wednesday, we got several earnings reports, including positive surprises from Costco, Saratoga Investments, and Helen of Troy, and a big negative surprise from Bed Bath & Beyond. Pre-market Thursday, we got a big positive surprise from Lennar, but the company issued weak guidance for 2020. Overall, I think it was a pretty fair start to the earnings season, but it does confirm that real estate and construction look like a weak market segment going into 2020, as we previously discussed on the podcast. Thursday, the market moved higher on mixed jobless claims data. Number was a little bit better than analysts expected, but we did hit a 1.5-year high for the number of Americans on unemployment rolls. And even though we're down for the fourth consecutive week in terms of jobless claims, we are still above the recent 25-day average. So we have seen a little bit of a cooling in the labor market in the last few weeks. And it's not enough yet to where it's a warning sign, but if we get a few more weeks of poor job numbers and worsening jobless claims, we may have to start worrying about a possible recession again. So we'll keep you updated on that story as it develops. And on Friday, we got the official federal jobs report for December, which came in a little under analyst expectations for both wage increase and the number of jobs added to the economy. Wasn't a terrible report, but it was weak enough to elicit a negative reaction from the market as stocks moved a little bit lower. The leisure and hospitality sector continues to be one of the strongest categories of jobs, with 40,000 new jobs added in that sector. And retail was also strong, although that probably mostly reflects just seasonal workers who were added to payroll for the Christmas holiday. And manufacturing continues to be a weak sector, losing 12,000 jobs in December. Going into next week, we should see a trade deal signed on the 15th this week, as expected. And if that happens, then we could potentially see a positive reaction in the stock market to that. And particularly manufacturing stocks, energy stocks stand to gain from a trade deal with China. So particularly look at oil stocks this week. Last week, we watched a number of energy and aerospace stocks because of the developing Iran conflict. Those did well early in the week. However, when tensions cooled with Iran midweek, we did see those stocks drop off. So hopefully you exited when you saw the tide changing on that story about the Iran situation. Baidu did surge 8% this week, so that was a very successful pick this week. Partly it surged on news that it had launched a new cryptocurrency, and partly it surged on an upgrade from a Chinese analyst firm that says that Baidu's core advertising business should recover in 2020, and it's also adding new revenue streams. That analyst firm set a 160 price target versus the closing price this week of 144.51. We may see a bit of a pullback in Baidu next week, but I am going to continue watching this stock because everything I see tells me the company has an aggressive plan for growth and it's executing that plan and really getting things done. It's still way below its highs from 2018, so I think that it's got a lot of room potentially to run up this year on optimism around all of its growth initiatives. Based on falling fuel prices and the continuing strength of the leisure and hospitality sector of the economy, I'm also looking at Carnival Cruise Lines this week. It's at about 11 forward PE, so a very attractive valuation, and it pays a 4% dividend, which gives you some protection in the event of a recession, if a recession should come. I'm going to be particularly watching what happens around the signing of the trade deal on the 15th. If oil moves significantly higher, then I will want to stay away from travel and transportation stocks like Carnival Cruise Lines and the Jets ETF, and also Trip.com, which is another one that I've been watching. So these stocks would react potentially negatively to an increase in fuel prices if that should happen in connection with the trade deal with China. But if energy prices remain stable at their current levels or even fall this week, then I am going to be looking at entering some of these travel and transportation companies, and particularly Carnival Cruise Lines, because it's in not only the travel and transportation sector, but also that leisure and hospitality sector that's looking so good on the jobs reports. I'm also liking the fundamentals on HP. I know I've sort of poked fun at HP on this podcast before for being a dinosaur, but it's been growing its earnings lately, and the PE under 10 with strong analyst ratings and over 3% dividend yield makes this a surprisingly attractive stock to hold for 2020. It's got a great valuation, and it is growing its earnings despite being kind of an old school company. So if you like tech stocks, give HP a look, because this is one of the few tech stocks right now that is at a really good valuation. A lot of that sector, unfortunately, is pretty overvalued at the moment. But this is potentially an opportunity to gain a growth stock for 2020. If you liked what you heard on the podcast today, please give us a like, share, or comment. Under the video on YouTube, you can find links to our Facebook and Twitter pages. You can give us a follow on there. Or you can follow the link to Webull. There's a referral link, and you can open an account on Webull, deposit $100, and then you get a free stock, we get a free stock, and that helps support the podcast. We'll be back next week with a full-length episode with me and Robert. In the meantime, trade safe and have a great week.